Welcome to this week's ASX edition of Trade the Trend, a weekly video discussing where the stock market is going. This video is going to focus on the ASX 200. I'm also going to look at the latest developments in gold, copper and uranium. So sure you stick around for that. I'm going to cover the S&P 500 in a separate video and I'll leave a link for that in the description section below. As always, this is general commentary. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the ASX 200 up on the screen, and it's been an interesting week. The pullback that we've been discussing, or I should say the potential of a pullback that we've been discussing over the last several weeks, now seems to be underway. And we've had this situation where the ASX 200, it was just getting so stretched above these moving averages. So I'm looking at the 50 and the 100-day moving average. Quite often when a market gets so stretched above those averages, it tends to pause and pull back towards them. And it's simply a case that every rally needs to get checked by a period of consolidation. And I think that's probably what we're now seeing occur in the ASX 200. So the question now is, where could this pull back to? So one thing we can do in terms of trying to identify a potential pullback point is to use Fibonacci retracements. So to do this, I'm going to use the low point from the most recent advance to the high, and we get this Fibonacci region, which comes in at around, at the top of it's around 7,300, just below 7,300. So that becomes a bit of a natural target point for the market to pull back to. And you might be thinking, oh, look, we're still a bit above there. Could it really come back that far? Interesting just to look at this previous period. Just move the scale of the chart so I can draw this in. And looking at this previous period, from the low point to the high point, and you can see how the market came back. The ASX 200 came back to first to the top of the region, of the Fib region, and then it came back to the 50% mark. So it's doesn't always work out like that by any stretch, but it's a good approximation, and it works quite well in giving ideas. And the other point to note about the Fib region, it also coincides with roughly where these moving averages currently are. So they're going to move a little bit over time, but a pullback towards this region would also bring the market back towards the moving averages, which again is quite a common thing that you see in a rising market. You get these retests of the averages, and you get another rally. And I think what this pullback looks like is going to be really important in terms of gauging where, can this market continue to rise over the next several months? So what we want to really see happen here, as the market comes back, we want to see buyers step up, and we want to see accumulation happening. And if we get that, then that could create the platform for a retest of this next resistance band. So ideally, what we'd see would be something like who knows how this is going to develop, but a consolidation that looked like that could then set the platform for a retest of this resistance, which is up at around 7,600. That being a triple top and also marking the all-time high in the ASX 200. It's interesting just to go back to a previous period. Like, these things never play out the same way, but just gives you an idea of the sort of price action which I'm thinking is possible. It's so just looking this period through here, we had it's also a triple top. 1, 2, 3, triple top resistance. Market pulled back. Market ran up towards it, stalled, pulled back, and then from there it was able to punch through. So that's not dissimilar to the sort of price action that we have now, in that we've got the triple top, the market's pulled back, the market's run back up towards the resistance. Now we're going to see what happens. What sort of pullback do we get? Of course, this could start to unravel. Maybe it continues down to a new low. That's not the setup at the moment, but we don't know. We've got to wait and see how it develops. But the positive price action would see the market move sideways, perhaps sideways to lower, build up a platform for maybe a retest of those highs. But as I say, we need to see how the price action develops. And as I said last week, pullbacks aren't necessarily a bad thing. They keep a market in balance, and they stop it from getting overheated. A bit like breathing. You've got to inhale, you've got to exhale. You've got to do both. You just can't keep going one way. Market's the same. We've done a big inhale. Now we just got to exhale. Then we can hopefully see the market take another leg. And moving on to the small ordinaries, just having a brief look at the small ords this week. It's a similar story. The small ords has, last week we were talking about the small ordinaries had started to pull back, and it's continued that through the week. It's now back to these moving averages, back to the 50 and the 100-day moving averages, putting on some Fibonacci's, give an idea where we are. We're back at around the 50%. It'd be good to see some support starting to come in for the smaller stocks around here. I think the way this market's now set up, both the ASX 200 and the small ords, I think the way it's set up, I think we can be patient. I think investors can be patient in both buying and in selling. I don't think there's a rush to buy stocks at the moment with the markets pulling back. We want to see how the pullbacks develop. But then I don't think there's also a rush to sell, because this could well be an advance. It could be a consolidation before another leg higher. So that's why I think we don't want to be in a hurry to sell, unless, of course, stocks are coming back to exit points where they need to be sold. If a stock is become weak to the point where it's past the level which it should be held, a stock, of course, should be sold. But if a stock has been generally trading upwards and it's having a modest pullback, I'm inclined to hold those stocks. Got to sit through. You've got to sit through consolidations to stay on larger trends. And I'm still long the market. I'm still seeing good gains across my portfolio. I'll show you what I mean with my portfolio. This is from my website. From the homepage of my website, you can see my own portfolio, my Motion Trader portfolio, which is my own money, my real money portfolio. And it's tracked by this software. This is really good software. It's called Navexa. It's portfolio management software. It's all done online. You don't need to download anything. It's all done through the Navexa website, and it's great because I enter my trades, or my trades can be uploaded automatically from my broker, and this is I rank this from best stock down to worst, so you can see the performance. These are the stock codes. They're all my stocks tend to be small to mid caps. I focus at the smaller end of the market. And a lot of these stocks have been put on over the last maybe 6 to 9 months. So you can see the sort of gain which I've gotten over that period. Just scrolling down the table, a lot of stuff in the in that mid 40 range. And I hold up to 80 stocks. I have quite a few stocks, and then of course you get into the losses, because it's not all wins. You've got the losses there as well. And again, that's what we use risk management for. But these losses are moderate. They're within the tolerance level where I hold. And then we go down. The worst performers, 23%. That's getting to the exit point. You see, there's nothing below there because I'm cutting losses. I'm running the winners, so you can see I've got those big gains up around 100%. But then I'm cutting losses, so nothing really gets much below that 25 sort of percent mark. So, and then you can see there's my portfolio. There's my real money portfolio going back to October 2015. This is accumulated profits. So in the last 7 months, it's gone from 680,000 to 740,000. So there's 60 grand in the last 6-7 months. So that's what's been going on in my portfolio. So look, it's a case of letting those profits run and then using those risk management strategies to exit those stocks that are lagging. Now, okay, so let's get over to the commodities. But look, first of all, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube people are watching, and YouTube will keep showing people my videos, which helps me so much. So please do that, and hit the subscribe button if you haven't already, and come over to Motion Trader and have a closer look around what I'm doing with my portfolio, and they're all, of course, Motion Trader stocks which a lot of my members are holding as well. Come and see what I do. See what I do might be able to help with what you're doing. Now, enough about that, and let's get into some commentary on gold. So it's taken a few more weeks than I thought, but we're finally getting that pullback, which was, it's always inevitable when a market gets stretched above the moving averages. It's a matter of time before it just comes back and retests it, and when it happens in gold, it is often swift, and gold didn't disappoint this time around. We had gold's typical swift pullback towards the moving averages, and that's why I've been suggesting some caution over the last few weeks, as we had this slow grind higher, this overlap price action in gold. It was a sign that it was running out of steam and we were due for a pullback, and that's why I said, just for me, it was a case of holding what I had, but not rushing out to buy a whole lot of new stuff, because there was a high probability, at least in my view, that sort of price action was coming. And it's funny when a market's rising, you feel like you've never got enough, and you always, I wish I'd bought some more on the way up. But then as soon as it pulls back, often you think, geez, I wish I didn't have so much. So it's just the way markets are. We've got to remember when markets are high and chugging along nicely, that they will pull back, and we don't want to feel we have too much. So being conservative, not getting greedy as a market's running. You want to be able to hold on during the pullbacks, not have a top heavy position and get shaken out. It's the indicator that I was using during that period was the rate of change. This is just a handy one just to keep an eye on for your own reference when you're looking at stuff, because we got that really nice divergence. We had the price going up, but the rate of change just kept deteriorating. It was a sign that gold was losing momentum. Doesn't always play out like this, but it's just one of those indicators which is nice to be aware of and to be able to keep an eye on. A lot of the time it's not relevant at all. You're just looking for the periods where you can get that divergence, either bullish or bearish. It can help you around how you manage your portfolio. Okay, so let's go on and have a look at copper. So copper this week continues to pull back. We're talking about last week. We had the pullback underway. Same story, stretched above the moving averages, pulling back towards them. Now getting pretty close to those moving averages, also coming up to this support around $4. For me, we had this strong upward move during January. It just may take more time. It's price-wise, the pullback looks fine. We'll come to the top of the averages, but I'm just not in a hurry to go out and do much in this. Maybe we're going to get another period like this that we had during November, where the price moved sideways. Like we had a strong advance, then we had a sideways movement, built a platform to launch higher from. Maybe we get something similar to that, where the price moves sideways, provides a launching pad for another move higher. I don't know how it's going to play out. I like the overall structure. When we step back and we get some more data from the 2020 low, it does look like we've had this big corrective move. We've got a rounding base. Looks constructive overall, medium term. But how this plays out in the near term over the next few weeks, I don't know. Next few months even. So let's just continue to watch how this price action develops. And lastly, just jumping to uranium. It's been one of the stronger performing commodities over the last few weeks. We had, let me just throw some moving averages on. We had a pullback towards the moving averages last week, got a quick buy the dip. Market ran higher again. But the timing of all this, it's like, I think I want to play this. I think the asymmetric play is to the upside in uranium, but we don't know the timing. This sideways consolidation could drag out for months. We just don't know. We don't know when. Of course, we don't know if it's going to break to the top side. But when we get signs of strength, I want to be playing it from the upside. Maybe we're going to get some consolidation if we get a general pullback in commodities over the next few weeks. But I think the overall structure continues to remain good, remains encouraging. So that's where I want to be playing uranium from the upside. So let's leave it there for this week. Let's call that a wrap. Hopefully it's been helpful and interesting. And thank you for joining me. Give me like, and look forward to talking to you again next week. Until then, bye for now.